Do you ever wonder if your investment portfolio is really invested well in the way it should be to have the best potential for long-term success? What about if you're making the same investing mistakes that professional investors commonly find in physician portfolios? Today we're going through a composite case study of actual mistakes we find in real physician portfolios so that you can get the answers that you need in order to improve your portfolio's performance over time. Welcome to Wealth Matters for Physicians, the channel brought to you by Altfest Personal Wealth Management that provides physicians with key investing and personal financial planning strategies. For 40 years, physicians have relied on Altfest to help them achieve their financial independence and future that they deserve. We'd be honored to help you. My guest today is Dennis Huergo. Dennis is a Director of Client Services at Altfest and has the Certified Financial Planner, the Chartered Financial Consultant, and the Chartered Life Underwriter designations. Well, Dennis, thank you very much for being with us today on Wealth Matters for Physicians.
Thanks for having me.
Excellent. So let's get right to it. So today we're discussing a case study of pitfalls we often find in physicians' portfolios. But before we even start to get into those pitfalls, can you give us a little bit of an overview of this physician couple, the Smiths?
Absolutely. If you go to the first slide, what you'll see there is a little bit of an overview of these folks. Now, they're a married couple, both in their mid-40s. They're two physicians, one's a surgeon, one's an internist, and they're extremely busy. I mean, we had to take meetings in between surgical procedures. They were scrubbing into the OR and said, I have 15 minutes. Can we cover X, Y, Z in that time? So you can imagine. On top of being in very busy and demanding professions, they had 3 children, aged 4, 6, and 8, and living in NYC. So quite a hectic schedule. And they really came to us because they were with a solo advisor that was part of a larger brokerage firm, and they just really felt underappreciated and underserviced, and felt that they really weren't getting the education that they wanted. And that's what really we became for them, was a partner not just in giving them an idea of what to do, but also why we're doing it, because they had to make a choice, right? Either you can be at the top of your field and be a good family person, family man, family wife, right? Or you can sit there for endless hours on Google trying to figure out what the right answer to your question is. And so they chose to partner with us in order to prioritize their time effectively.
That sounds great. Thank you. So Dennis, one of the pitfalls, investment pitfalls that you identified for the Smiths was that this concept of performance chasing. Can you explain to our physician audience what performance chasing is? Absolutely.
So performance chasing is when you look at something that did really well the previous year, like technology in 2020 or 2021, and you say, you know what, that's the future, I want to invest in that, and you over-concentrate your portfolio in that sector. What that sets you up for is long-term returns that are less than ideal. It actually hurts your portfolio in the long run.
Thank you. And then the second investment pitfall you found in the Smiths portfolio is that they were very concentrated in their portfolio, not very diversified. Could you tell us what you found?
Yeah, so about 40% of the portfolio here was invested in technology stocks, which are mainly domestic technology stocks. Think Meta, Facebook, Tesla. And so that led to an over-concentration in domestic equities, which are right now a bit overvalued, historically speaking. So they basically put all their eggs in one basket, and it was the U.S. market, and not only the U.S. market, but mostly in the technology side. Now, if you have an excess of capital and you know you're okay for retirement and you're okay with gambling a little bit and saying, I'm going to speculate on the future of this industry or that company, then so be it. No one's going to stop you. But if you're relying on this money for your retirement, you really shouldn't be speculating, and you should be more well diversified, not only in terms of the asset class that you invest in or the sector, but also in terms of the countries that you're invested in.
Thank you. So Dennis, why is diversification so important to portfolio success? Why do we at Altfest hammer this over and over again so that physicians can get a great return on their portfolio over the long term?
Yeah, well, I once heard it said that diversification is to an investor what humility is to a normal person, right? We don't know which asset class or which stock is going to go up in the future, especially not in the short term. So what we want to do is diversify our exposure so that we hedge our risk of one specific asset class going up or down and working against us. And so if we go to the slide on this, we'll actually show our quilt chart. Now, this quilt chart looks at the annual returns for a range of different asset classes across a 15-year period. Now, it has everything from stocks and bonds, whether they're large cap stocks or emerging market, international, sort of a variety there. As well as cash. And on the far left-hand side of that chart, you'll see the annualized returns and the annualized volatility over the last 15 years. So what does that show us? Well, in 2008, everything pretty much did pretty badly, Michael, right? But the worst asset class was emerging markets equity. It actually lost over half its value. Now, if you would have said, you know what, I don't want to diversify. I want to pile into fixed income because that did okay in 2008, and I would really want to avoid emerging markets equity. The next year, in 2009, emerging market equity outperformed by 80%. It grew by 80%, and fixed income stayed at around 5%. So nobody could have called that. There's no way anybody in their right mind would have said, you know what did worse the last year? That's what's going to do best the next year, right? And if you tried that in 2009, it would not have worked out very well for you going into 2010. So you want to diversify because there is no way to know. There's way too many variables, but what you do want to create, and if you see on this chart, is a diversified portfolio, this asset allocation portfolio in the white boxes that'll show you can temper the volatility and the risk simply by decreasing the exposure to any one specific asset class.
That makes a lot of sense. Thank you. And so building on the subject of diversification, why is it so important to have a lot of international stocks, or a good amount of international stocks? Many of our physician clients say, I'm not so excited about international, I'm kind of worried about what's happening in different parts of the world. Why does it make sense to have international equities?
And those are extremely valid concerns, Mike. I think that there's always a reason to avoid any part of the market. But if you look at sort of the historical performance, we actually have a slide on this. If you look at the historical performance of the international market, which we'll call the European, Asia, and the Far East markets, the MSCI EAFE, and then we'll look at the U.S. market, and that will be represented by the S&P 500 index, going all the way back to 1973. You can see they take turns outperforming one another. It's not like the U.S. markets have always been the best place to invest. In fact, from 1973 to 1976, international outperformed. It did so again in the late 1970s. It did so again in the mid 80s. It did so again briefly in the mid 90s, and then from 2000 to 1 or 2 to about 2008, international was the place to be. Now, if we do, going back to maybe 2009 and onward, where the U.S. had 0% interest rates and certainly a favorable growth market, you might say, you know what, the S&P is the place to be, at least over the next 10 or 15 years, at least over the last 10 or 15 years. But we don't want to try to predict what's going to happen, but rather have exposure to different areas of the market.
That makes a lot of sense. And also, I know what we're noticing at Altfest is that the valuations of international stocks are much more attractive than the valuations currently of domestic U.S. stocks. So they have more room to run up when their economies do well.
That's right.
Okay, Dennis, so again, riffing on diversification. Many of our client physician portfolios, when we look at them, they don't have a lot of alternative investments. First of all, can you explain to our physician audience, just generally and briefly, what are alternative investments and why could it be a good thing to add alternatives to one's portfolio?
Absolutely. So what we see in most portfolios are stocks and bonds, and that's great. That should make up a good majority of most portfolios because they have great growth potential and income potential. However, there's the question of correlation, right? Sometimes different stocks are correlated to one another, right? They move in sort of similar directions. Now, alternatives are completely different. It's a really big umbrella. It could talk about it could include real estate in its different forms. It could include hedge funds, private equity, private credit, and a slew of other subcategories of alternatives. Now, the beauty of alternatives is they don't move in the same direction as the rest of the market. They do their own thing. Now, they certainly have their own ups and downs based on what's going on internally, but it doesn't have as much to do with the market. And so that's what we want. Going back to the previous slide on diversification, we want to make sure that you have as little correlation to the public equities as possible, and alternatives do a great job of doing that. Now, if you look at this slide, you'll also see that alternatives are able to reduce our risk while increasing our return. So going all the way back to 1989, this chart is showing us that adding a diversified sleeve of alternatives, again, that could be real estate or private equity or hedge funds, to a traditional stock and bond portfolio can help manage that risk and improve the return. So if you look at like a normal 80-20 portfolio, if you introduce 30% alternatives and drop the equities down to 50%, it could take the risk or the volatility from 12.8% down to about 9.5%, which is significant, and increase the returns from 9.2 to 9.4. And that's really something, right? So you can have more returns and less risk. Who wouldn't want that?
Exactly. Like I said, as Dennis is saying, who would not want that? No one wants more risk and less return, but if you can get more return while having to take on less risk, it's kind of like having your cake and being able to lose more weight. Who wouldn't want that? Thank you very much. Great answer. Rounding out our questions on diversification, I know you wanted to bring up the subject of municipal bonds for physicians. What about that? Why is that good?
Well, most of the physicians that we work with right now are in the highest tax bracket federally, and if they're living in New York State, they also are pretty high up in the New York State tax bracket as well. And if you're living in Yonkers or New York City or Westchester, right, there's sometimes local taxes that factor in as well. So anytime we create income in a portfolio, especially when it's taxable income in a brokerage account, like with bonds, for example, if you can get tax-exempt interest in there via municipal bonds, they can really increase the after-tax yield. So there's a conversion there for the after-tax equivalent yield of municipal bonds compared to taxable bonds. And right now we're seeing yields of over 7%, which is great because it's not very much risk in a highly rated municipal bond. Especially not compared to an equity, but you're having a yield that's very attractive, and it's not adding, and this is key, it's not adding to your taxable income. It is tax-exempt income at the federal level and state level.
Excellent. And just to also let our physicians know that at Altfest we are constantly shopping the municipal bond market. We're working with multiple bond sellers to find really quality bonds, and if we don't find any quality bonds, we just don't buy.
Absolutely. The market is so fragmented where you can't just simply index something like that, because there are some municipalities that are doing very well, other municipalities are having tough time making payments, and you do not want to be on the wrong side of that ledger.
Excellent, thanks. Okay, Dennis, so now you made a great case for diversification in many different facets of the investment universe. So could you then just show us an example of an Altfest portfolio in terms of its diversification versus, let's say, a physician portfolio that we sometimes see when they first come in?
Absolutely. Let's actually take a quick look at the Smith's portfolio, because it's a great example of a contrast between what we typically see, in this case it was actually their portfolio, versus what we proposed.
Sounds good.
So now if you look at the screen, what you'll see is they had about 96% exposure to equities. We dropped that down to about 70, right? And most of that is because we wanted to take 50 and put it into domestic equity, and then take 21% and put it into international exposure, which they had almost none, right? Now, in terms of bonds, they had no bonds, but they actually, right now, the yields are pretty good. And so especially if you're looking at retirement accounts or any tax sheltered accounts,
right,
bond yields are fairly attractive. So we put about 8% in bonds there. And this was a while back, so this could actually be a little bit more enhanced now and still make sense for them. But most importantly is the alternatives, right? We give them access to about 20% alternative investments in that portfolio, whereas they didn't have that before. And as we discussed previously, that's going to give them the potential for increased returns with decreased volatility, which, again, who wouldn't want that?
Right, and especially with alternatives, especially in today's markets right now, we're filming in early December 2023, When there's a lot of volatility, especially volatility on the downside, negative volatility, alternatives, because they don't act in lockstep with traditional stocks and bonds, can be down less or can even be up. So they can be very helpful to one's portfolio.
Absolutely.
I think you've given our physician audience a lot of great ideas to think about. Thank you so much for being on the channel today.
Thank you so much for having me.
If you'd like to discuss the information explained in today's video, receive a complimentary review of your investment portfolio or a retirement readiness analysis, or discuss any other personal financial planning areas with an Altfest professional at no obligation, please contact my colleague Jesse Freeling at 212-796-8732 or by emailing Jesse at his email address, which is also in the description of today's video. If you like today's video, please click the subscribe button below and hit the bell icon to receive notifications each time we release a new one. If you think that a fellow physician would find this video interesting or useful, please feel free to share it with him or her to help them strengthen their personal finances. Lastly, as always, if you have topics you'd like us to cover, questions you'd like us to answer, like or dislike certain things that we're doing, or have any other feedback, we'd love to hear from you. So please give us your comments in the comments section below. Well, that's all for now, physicians. Thank you so much for being with us in today's video, and I look very much forward to being with you in the next one. Until then, please keep optimizing your finances, or let us help you if you'd like. It would be our honor.